It's Matt Santagapita with the Mulligan Realty Group, and this is another episode of our Monday Market Update coming to you live from the inside of my car. So in this episode, I'm going to go over the numbers. I'm going to talk about one interesting data point, at least I think it's interesting, and that's going to be inventory levels and where they're or where they are heading, or where we seem to be heading, I guess I should say. But I'm also want to touch on fixed rate mortgage rates and talk for a second about how they're affected or what affects them. And I'm also going to include a little video there that gives a little bit of context. It's a video by Mark. He's a mortgage broker in the London area. And it's more related to kind of the US markets, call it, but the same kind of thing applies. Anyways, let's get into the numbers. So new listings for this past week came in at 319, conditional solds at 98, sold, so pending closing, 111, price drops, 108. Now, the fascinating thing about numbers here is in the last 30 days, we're seeing inventory numbers in London have increased by 30%. So with that being said, London is most likely going to be in a full-blown buyer's market very soon. There's an argument to be made. It kind of already feels like that a little bit because no one's really in a rush. But definitely by the time summer, we are full-blown buyer's market. 30 days to see 30% increase in inventories, pretty steep increase. It is also normal this time of year to see that type of increase, so it's not alarming or anything. It's just 30% in 30 days is significant. Now, the other thing I wanted to talk about, as I mentioned at the start, is fixed rate mortgage rates. I've had a lot of people bring up this topic. I know a lot of mortgage brokers have heard this topic. They hear, oh, the Bank of Canada's dropping rates, my rate's not dropping, or fixed rates aren't dropping. What's going on? And I think a lot of people don't realize how a 5-year Canadian mortgage rate is determined. In essence, it is determined by a bond rate. And now bond rate, so as an example, would be if the Canadian government is in debt and they need to finance their expenses, they go to the bond markets and they sell short term, so call it 1, 3, 5, very long term, 10-year bonds. And in reality, when governments overspend, you have to offer a higher return. And essentially, that's what you're seeing in Canada and the United States. And that's why one of the reasons you're not seeing fixed rates really coming down is because, truthfully, there's no other way of saying it, is that our governments are spending too much money. And in order to attract the investment from the globe to give, whether it's the United States, which needs trillions, or Canada needs billions, people have to get a return, whether that's for a pension fund, whether that's a foreign government. They have to get a return for their investment. And the riskier they see that investment, the higher of a return they need to get. So as long as our governments keep spending money like drunk sailors, fixed rate money is just probably actually going to get higher. To be honest, I actually do believe that probably a few years from now, I do think we're going to see fixed rates go up. I think we are going to go into a little bit of lull. I do think the Bank of Canada will do a couple more rate decreases, but overall, I think the, seeing 5-year money in the threes, I think it's kind of long gone. I do think it's in 4s, and the only other thing that's probably going to help there is you got to get the cost of living down for housing, and I don't think anybody can figure that out because that just turns into a big political argument on things. So anyways, again, Matt Santagapita with the Mulligan Realty Group, and this has been another episode of our Money Market Update.